Last month, I logged into my credit card account to pay my bill. A pop-up appeared before I could do anything else. Update your annual income to help us serve you better. There was a friendly little form with my old income pre-filled, and a box inviting me to enter my current number. Serve me better, that's what they said. I closed the pop-up without updating anything, because I know exactly why they're asking, and it has absolutely nothing to do with serving me better. Here's what most people don't realize. When you tell a bank your income, you're handing them ammunition. You're giving them data they will use to make decisions about your financial life, decisions that benefit them, not you. Every single time you update that income field, algorithms start running, calculations begin. Your profile gets adjusted in ways you'll never see, but will absolutely feel. Banks have convinced us that sharing income information is routine, expected, maybe even required. They slip income questions into applications like they're asking your phone number. They send those friendly update requests disguised as customer service. They make the whole process feel so normal that most people never stop to ask a basic question. Why do they actually want this number? And what happens when they get it? The answers might fundamentally change how you interact with financial institutions from this point forward. Let me start with something that will probably irritate you. Banks are not required to ask for your income in most situations. There's no law mandating that credit card companies know your salary. There's no regulation requiring your bank to have updated income information on file. They ask because they want to know. They ask because knowing helps them make more money from you. This distinction matters enormously. When something is legally required, you have to provide it. When something is requested, you have choices. Banks deliberately blur this line because informed customers make decisions that hurt bank profits. Think about the last time you applied for a credit card. The application probably asked for your annual income. You probably entered it without thinking. Why wouldn't you? It seems like standard information. Everyone asks for it. But here's what happened behind the scenes the moment you submitted that number. The bank's algorithm instantly categorized you. Your income became a data point in a profile that determines how they'll treat you. Not just whether you get approved, but what interest rate you'll pay, what credit limit you'll receive, what offers you'll see, and how aggressively they'll market additional products to you. Let me break down each of these because the mechanics are fascinating and slightly disturbing. Credit limits are the most obvious use of income data. Banks use your stated income to determine how much credit to extend. Higher income generally means higher limits. This seems reasonable on the surface. Someone earning $150,000 can theoretically handle more debt than someone earning $50,000. But here's the twist. Higher credit limits aren't always in your interest. They enable more spending, they create more opportunity for debt accumulation, and they increase the total interest you might pay over time. Banks know that people with higher limits tend to carry higher balances. A $30,000 credit limit doesn't just mean you can spend more. It means you probably will spend more. The bank isn't giving you a high limit as a reward for your success. They're giving you more rope because customers with more rope tend to hang themselves with interest payments. Interest rate determination is where income data gets weaponized in ways most people never see. You might assume that higher income leads to lower interest rates. After all, higher earners are lower risk borrowers, right? The reality is more complicated. Banks use income data in combination with other factors to determine not just your risk level, but your price sensitivity. Someone earning $200,000 might be less likely to shop around for a better rate. Someone with substantial income might not notice or care about a few percentage points difference. The algorithm knows this. It adjusts accordingly. Studies have shown that affluent customers sometimes receive worse terms than they should because banks correctly predict they won't bother negotiating or switching providers. Your high income becomes a signal that you can be charged more without losing your business. This practice has a name in banking circles. It's called ability to pay pricing. The more you can afford, the more they charge. Not because you're higher risk, but because they can get away with it. Marketing and upselling represent the most persistent way banks use income data against you. The moment you reveal your income, you get categorized for targeted offers. High earners receive aggressive pitches for premium cards with high annual fees. They see constant offers for personal loans, investment products, and insurance packages. Every login becomes an obstacle course of upsells, carefully calibrated to your income bracket. Banks know that someone earning $180,000 is more likely to say yes to a $550 annual fee card than someone earning $60,000. They also know that high earners often have more financial complexity, which creates opportunities to sell additional services. Your income data isn't just sitting in a database. It's actively working to separate you from your money. Lower income customers face a different version of this problem. They receive fewer premium offers, but more predatory ones. Balance transfer promotions with hidden fees, personal loans at steep interest rates, credit limit increases specifically designed to enable overspending. The targeting is precise because the data is precise. There's something even more concerning that most people never consider. Income data persists. When you tell a credit card company your income, that information doesn't disappear after your application is approved. It sits in your file. It gets used for decisions you'll never know about. It gets shared with affiliates and partners in ways that privacy policies technically permit, but most customers would never expect. That income figure you entered 5 years ago might still be influencing how you're treated today. It might be factored into decisions about whether to increase your interest rate, decrease your credit limit, or close your account during economic uncertainty. Banks have long memories. Your data has a very long half-life. Now let me address the question you're probably asking. When do you actually have to disclose income, and when is it optional? Mortgage applications require income verification. This is federally mandated. Banks must confirm your ability to repay under qualified mortgage rules. You'll provide pay stubs, tax returns, and employment verification. There's no getting around this, and frankly, you wouldn't want to. Buying a house with no income verification is what caused the 2008 financial crisis. Auto loans typically require income disclosure, though verification standards vary. Some lenders do full verification, others accept stated income. The necessity depends on the lender and loan amount. Credit card applications ask for income, but here's what most people don't know. Credit card companies generally do not verify the income you report. They can't access your tax returns without permission. They can't see your pay stubs. They're relying entirely on what you tell them. This creates an interesting dynamic. Banks want income data badly enough to ask for it, but not badly enough to verify it. What does that tell you about how they're using it? Those periodic income update requests that pop up in your account are entirely optional. You're under no obligation to provide updated information. The bank wants it. They don't need it. Those pop-ups are designed to look mandatory while being completely voluntary. Let me be absolutely clear about something. I am not suggesting you lie about your income. Providing false information on a credit application is fraud. It's illegal. It's genuinely wrong. Don't do it. What I am suggesting is that you think strategically about when and whether to volunteer information that will be used to make decisions about your financial life. There's a significant difference between lying and declining to update. When a bank asks you to update your income mid-relationship, you can simply close the pop-up. You can leave the field blank if possible. You can decline to provide information that isn't legally required. This isn't deception, it's privacy. Consider the asymmetry of the relationship. Banks hold enormous amounts of information about you. They know your spending patterns, your payment history, your debt levels, and your financial habits. They use sophisticated algorithms to analyze this data and extract maximum value from the relationship. Meanwhile, you know almost nothing about their internal decision-making processes. You don't see the algorithms,